Hello and welcome to ATFX. My name is Nick Twidale. I'm the Chief Market Analyst, and this is ATFX's FOMC preview. As always, please do subscribe to our channel and we'll keep you updated on all the things that are moving markets. So probably one of the most anticipated Federal Reserve meetings and rate decisions coming up in the next couple of days. The volatility for markets, and we're going to look at a few of the key markets that could move on the back of this, will come from the forward guidance that we get from the FOMC statement, from the dot plot, which is key, and from the press conference that we get from Jerome Powell. So there's actually two real key risk events that come up with this FOMC meeting. So the initial rate call, and we get the statement and the dot plot at the same time, and then we have the press conference later on. So there's two kind of trading opportunities that come, and sometimes the message that we get from the press conference can slightly differ from what we get from the statement and from the dot plot, and then markets could be off to the races. There is a potential that we don't see too much out of this one because we are 96% priced in that we will get 25 basis point cut from the Federal Reserve. If we do not get either a cut or they go by 50 again, then we will see massive moves in the market. It is highly unlikely. If they do not cut, expect the dollar to appreciate massively across the board. We'd see currencies getting smashed, euro probably heading towards parity. If they went by 50, the dollar will get smashed completely and the currencies will rally, and we'll probably see euro back up to 110 as a guide. But in all probability, what we've got to look at now for the trading opportunities, and I'll switch over to charts in a second, is what we get as an indication of, and whether they stay with a bit of a dovish tilt or a more hawkish tilt, which is kind of where the market's leaning, to be honest. That'll be where our trading opportunities are. So I'm going to switch over to our trading charts now, and we'll have a look through the majors and through gold just to see where there's potential for these moves to occur and where we're probably going to get the biggest bang for our buck. So I'm starting off here on the local currency for us here in Australia, the Aussie dollar. As you can see, in line with most of the majors, we've seen a strong appreciation in dollar, depreciation in the Aussie, and we are sitting off very close to sort of recent annual lows, 63.35-ish. We're only 35 points above that at the moment. So let's take out the possibility of a rate hike or nothing or the 50, and let's just look at what the probable trading propensity is going to be here. So if we get a slightly more hawkish tone and the market's leaning that way, we will see dollar buy. And there's a good reason for this. The trend has been for the dollar to go up, Aussie to go down. We could see very quickly, and that would come with a real pullback in rate cut expectations next year through 2025. And the reasoning behind that is obviously because we've got a Trump government coming in. Tariffs are expected to be implemented fairly hard. Regulations expected to be pulled back. That's inflationary pressures. The dollar goes higher. You won't want the Fed to be cutting as hard. And the Fed are aware of what's going on. And that's why markets pricing in when they are. If we get a more hawkish tilt, which would be the hawkish side is actually less cuts, we could see a breakthrough very quickly of these recent lows. That trend line support's coming in at 63.37 there. 63.34 is local. And a breakdown really does open the way up for a move down to these much deeper levels. I think 61.70 is one of the first levels that comes down on the deeper chart. And away we go. So that's the Aussie for you. Obviously, the inverse is equally true. If we do get a more dovish tilt, and they're going to continue, which they would have been doing 6 months ago, we were expecting more rate cuts coming through in 2025. We would see a move back up to these levels. Initial very short-term resistance is on that 200-day moving average, 63.93. We're then looking at 64.35. And then further, and a break would take us back up to these 65. So moving over, let's have a quick look at cable as well. Now, slightly different setup to the Aussie. We're kind of more in mid-range. Support coming in around about 125.50. Recent lows down here all the way at the end of November, 124.84. So you've got a little bit more room in this one. Now, once again, if we get a more hawkish, less dovish sign, expect the dollar to be bought. We'll see 125.50 maybe challenged relatively quickly. And then down to challenge these recent yearly lows. Top side resistance coming in, 200-day moving average is at 127.19. And the recent highs, we probably go back to this recent high instead of that trend line, 127.87. A more dovish, looking for more cuts, would see it move to the top side. One thing I would have to say, if you're trading the cable around the FOMC, is we've got a lot of UK data out this week, which will move cable. And also we've got the Bank of England just a day after the FOMC. So you probably want to have a more shorter term trade on cable than maybe you would on some of the other. So we'll move on to the major. Let's move on to Euro now. And that's a similar kind of story. There's less Euro data out this week as well. So you might get a purer trade just on the dollar side of it. Euro's sitting in the middle of the range, about 105.20. It's got room to go either side. So resistance coming in now, and it's interesting, this trend line comes in around 106.44, and the recent high is kind of around the same level. He's just got it up 106.30. Support coming in at 103.60 and that recent low. So once again, more hawkish. It will challenge these 103.60s, more dovish up here. I think there's quite a nice little trade. We have got a few sessions to go before we see the outcome of the FOMC, but these levels will remain constant unless they're broken in the meantime. So plenty of trading opportunities coming through in the majors, and it will move. I think we're going to see moves, whether we see something from the dot plot, from the statement, or from the press conference after. So, of course, here's another big one that we've got. And once again, something else that's got the double whammy of double central bank influence this week. Dollar yen, we've seen a massive rise off of dollar yen from these lows down under sub 149. We're up 5 big figures. We're up to 154. Kind of in the middle of the range as well. We're banging up against this longer term resistance, 155.50. Don't forget the dollar's the base on this one. So more hawkish, could see more topside. And that's one of the reasons why this move has come back in place. And over the last few months as well, because we have got a more or less dovish leaning for the dollar. Once again, we could challenge these on the more hawkish side. It could see us down to this 151.78 level. That's the 200-day moving average on dollar yen. You do tend to get more bang for your buck out of dollar yen at the moment. So, you know, if you're going to get like a 60, 70 point move in the euro, you might get 120, 150 points in dollar yen. Makes it a little bit more attractive. Once again, with dollar yen, if you're trading on the FOMC, don't forget the next day, and it's only really a few short hours afterwards, possibly only sort of 6 to 7 or 8 hours, because we never know exactly when the Bank of Japan are coming out, that we get the Bank of Japan rate decision. Now, they're expected to hold rates steady, but it could see more movement. So once again, maybe a shorter term trade for the dollar yen side of things. You might not get the trend because you've got that second central bank influence coming in. Now I'll move over to dollar CAD. Now this has had a sensational move, as most people will be aware. We did get a cut from the Bank of Canada last week. There's a bit of geopolitical shenanigans going on there with potential moves in government, which is not looking great, and also more downside potential. So this has been one-way traffic really since late September. As you can see, basing down there around 134.18. We are nearly 10 big figures with what, 8.5 big figures higher. These are annual highs. They're multi-year highs. Always consider when you're trading CAD that there's an oil influence, but certainly the Trump government coming in, inflationary pressures for the US market. That's why we're looking at the FOMC for the slightly more hawkish or less dovish leaning. Tariffs onto Canada, one of the local trade, obviously one of the big local trading partners for the US. That's why we've seen this depreciation in the loonie, and that's why we're up at these levels. Now, you could see some really big moves. If it comes in less dovish, more hawkish, we've just got to break these recent highs. I will bring those into slightly better context. Here you go. Recent high, and there's no line on this because we're far out on these hourlies on the trend line resistance. High at 142.68. It's only 30 odd points away. This could be where we see moves. We could see moves in the next few sessions as well, but more hawkish would certainly take out that high, move us forward into further fresh ranges. A more dovish side of things could take us down to challenge this 200-day moving average around 141.58. Once again, always take into account it is a double event, so we could get the statement, the dot plot, and then a slightly different message from the press conference. There could be volatility within these ranges. So plenty of opportunity there on that FOMC announcement and then on the press conference afterwards. And we'll just skip over to gold as well. Obviously moving really well in the market, it has seen another, and this is kind of inverse to what we've seen with the majors, right? Gold has appreciated really well. This is the longer term chart that we're looking at. It's still in this massive upward trend, even from when November, when Trump came in. We've seen the dollar appreciate against everything else. But with gold, we've seen gold appreciate with geopolitical risks. We know the geopolitical risks. We've had trouble in the Middle East. We've had war in Ukraine. Other geopolitical factors, including the tariffs from the US, have led to this movement up in gold. So possibility of a short-term move in the dollar. It will react initially to the dollar, but then we're probably going to be looking for this trend to resume. So support coming in now on these daily charts, around about 2,600 makes it nice and easy. We're just above 2,650 at the moment. Resistance coming in around about that 2,715 level. We could see a break higher on a much more dovish side of things. I would expect to see more range-bound conditions for gold. But once again, trading gold on the FOMC, you're probably going to get a short-term impact from the dollar, but then we're probably going to drop back into those geopolitical concerns. So perfect trading opportunities in a lot of these products. The main thing is to see, your first check is obviously they do cut by 25 basis points. Then you look at that dot plot to see whether they're bringing in those rate cut expectations again in 2025 and further out. And then we're going to listen to what Jerome Powell's got to say in the press conference. So very, very busy time. Expect trading ahead of that, especially in that New York session. We've got a little bit of data out, and then it's a long, long wait until the end of that New York session. Expect it to be range-bound conditions into it. So good luck with your trading. If you need anything from us at ATFX, please let us know. Thank you very much.